Now we will discuss next strategy, the famous covered call strategy. It is very popular high risk strategy. What is a covered call? In covered call, underlying stock is bought in cash equal to one lot of future, or some people buy futures lot. Then one lot of call is sold for one lot of future or shares worth one lot quantity. If profit, all is well, book position and be happy. This always works in strong bullish markets, like one we have seen in recent times post COVID. All stocks kept rising and anything bought has given profits from buying. At least the stocks did not fall much to bother buyers and profit came from call selling. But this is very high risk strategy if one doesn't know how to manage loss, and upside is capped if one does not know adjustments and how to do those adjustments. Downside is also not protected. Loss can be unlimited and underlying can take you for big roller coaster ride if position is taken in futures for trading purpose. If position is in cash for long term investment, then it is not a big problem, but then upside is fixed at break even point, and if there is big upside move, then there is no advantage. For example, this is Tata Motors. I had taken a breakout trade in Tata Motors on 23rd September when it broke above 315 levels. At that point of time, if someone takes covered call at 320, what will happen? Suppose one lot of futures is bought at 320 and call of 340 is sold at 20 rupees. So break even on lower side is 300 and trader will have profits capped at 360. If futures expire anywhere above 300, there will be profit. Maximum profit will be at or above 340. Trader will get maximum profit and call will not show any loss at expiry. But once stock crosses 360 and goes on to make high up to 400 or 500 levels, profit in futures will be negated by loss in call. So actual profit will always be capped, but what if stock falls below 300? Then what will happen? There is no protection on downside. It can keep falling more and more without any protection. If covered call strike is shifted down, then profit gets capped at lower level. Loss may reduce slightly, but profit will not come. And if put is bought to protect downside in covered call, then it will become synthetic future short position. So we have bought a futures long which was hedged with synthetic future short. What will happen in this case? If Tata Motors moves up, then profit is capped. If Tata Motors moves down, then loss is capped. And making too many adjustments in covered call may end up making more losses than profits. It is very important to select appropriate time to initiate covered call strategy, or else it may backfire. When IV is in zone 5 or zone 4, then calls have very good premium, and if at that time underlying is expected to remain sideways, then making a covered call will be very good idea. Covered call strategy is very good strategy if principles are understood properly and risk is understood properly. It has to be done only in those stocks which are selected as portfolio stocks for very long term, and any downside in that stock should not make trader nervous. This is not a strategy where active trader can rely as one and only strategy to trade. So let us see this in detail with example of Tata Motors. My trade in Tata Motors was based on momentum, so I had not done covered call for it. I had done bull call spread. I do not advise covered call for momentum trading, as covered call is good for mild bullish market with zone 4 or zone 5 IV with inflated option premiums. Now let us see how would trade go if covered call is initiated for Tata Motors. Suppose I bought futures at 320 and sold call of 340. 340 call was trading at very low premiums for September expiry on 23rd September when breakout entry was triggered. Lot size for Tata Motors is 2850. So if premium is less than 1 rupee, it will be just 2000 3000 rupees premium, and most members do not like to sell for so low premium. Then what is done? They either shift to at the money call to get more premiums, or shift to next monthly expiry to receive more premiums. Some people even do next month's at the money call as well as out of the money call selling. So more than one lot position sold for one lot of future by some people, and this is not advisable at all. Our basic premise is we want to hold stock for long term, and we will take rent in sold call, but we will not give delivery. We must know how to make adjustments so that giving delivery is not required when move is in our favorable direction. How can we do it? As a covered call strategy, I bought Tata Motors shares at 315, sold 340 call of next month expiry at around 13 rupees. Or I bought one lot of future and sold 340 call of next month expiry. Total premium collected is around 37,000. As long as Tata Motors is trading between 315 to 340, I will make profit in sold call or futures long or cash. I don't have to worry at all. But if Tata Motors start moving above 340, then sold call will be in the money call. We don't hold selling positions for in the money options because intrinsic value doesn't decay, and we have to shift position in options to next strike based on martingale principle. This will extend our range, and we will not have to give delivery of portfolio stocks. In a month with mild bullish move, we may need at the most 1 or 2 adjustments. But if there is strong momentum, then this will be very difficult because stocks can increase by even 20 or 30% or even more in few days, and we will be making very good profits in underlying, but our martingale position may show loss. Our futures position is one lot. When we do martingale, we have to increase and make the quantity double. So at first adjustment, we'll have 2 calls short, and if we require more adjustments, then against one future long, we'll have 4 lots of call short, or we may have 8 lots of call short. So this equation will get skewed. Every time there is increase in underlying, our 8 positions will be against our 1 position. But ultimately some option will expire worthless, and within a month we will be able to grab total premium of options sold, and will be very happy with profits in underlying. When we don't want to give delivery, then this can be done. But if we are having good profit and we want to give delivery, then we can exit our cash position and we can exit our call position. Here our maximum profit is capped. If we use martingale principle, then maximum profit will not be capped. This is the difference. I am just telling you what can be done. Whether to do it or not do it, that is in your hands. This is when our view is right. In covered call, view is right, underlying is rising, and we are making profit, we are happy. But what will happen if our view goes wrong? If stock goes down instead of going up, what will happen? Suppose stock has gone down to break even level of 300, then sold call will show some profit, but underlying will show some losses. Suppose we have taken position at this point 315 and our break even is 300, and stock falls below and comes to 300. What happens? Call will show some profit, but we will have loss in underlying. What can we do at this point? Here we need to do pyramiding. In same option, we have sold 340 call. Initial sale was at 13 rupees premium. Now premium may have come down to 7 or 8. So what will we do? We can sell that again. If we sell that at 7 or 8, we have to keep stop loss for our first option sold at 13 and stop can be placed at 12 rupees. We have discussed this in pyramiding. When we have additional position, we keep stop loss for first position. Many times this trailing stop loss is not hit if markets remain sideways. If fall continues, we can keep selling same option at lower premiums and do pyramiding. We should not shift to lower strike. It will cap profit. So this way, sell option at same strike as premium falls and keep trailing stop loss. If market goes down, we make profit from sold call and stock remains in portfolio. Anyways, we had taken that stock with view of keeping it in portfolio. But if it comes up, we will exit sold calls in small profit and our underlying will show us profit. This way it can be managed. This is unlimited risk strategy because underlying can keep fall to any extent. One can earn some premiums by selling calls, but it may not be adequate cover. For example, from 315, Tata Motors can come down up to 270 levels. So that will be around 40 rupees loss and any number of sold options will not cover that loss. But as we are willing to keep that stock in portfolio, then we will pocket some profit from sold call and we will keep the stock for portfolio. It will come up someday and it will give you profit. So this is a basic premise in covered call strategy. It has to be done only in stocks which are your portfolio stocks, which you are not afraid to hold for long time. So is this clear about covered calls? In covered call, we take position in cash or future, sell a call at higher strike, and if underlying goes up, we can do martingale so that we will not give delivery. If it comes down, we can do pyramiding and gain extra profit from sold call and will keep the underlying as our portfolio stock. Now let us come to next strategy. Next strategy is called as collar. Now what is a collar? Collar is adjustment in covered call. What do we do here? In collar we buy a future and to protect downside we buy put. A downside is protected, we have already bought put. So beyond break even point we will not have loss. Even if market falls by 20%, our maximum risk is fixed. Then there is one more leg. What is that? As we have spent money in buying put, we sponsor that put by selling a call. We have to sell another call which is giving us similar premium of that put. So if we buy at the money put, then we have to sell at the money call. If we buy out of the money put, then we have to sell out of the money call. This way premium of put is sponsored by premium of call. In short, this is future long position which is hedged with synthetic future short. What is advantage for this? Maximum loss is fixed. But what is disadvantage? Profit is capped and it is limited. And what happens if market goes sideways? There will be no profit. If market goes sideways and expires near entry level, then there will be no profit. If market goes sideways and expiry is below entry level, there will be some loss. If expiry is slightly higher, then we will pocket some profit. This is a position where we are buying a futures and hedging it with synthetic future short. Okay, understood what is collar? पट्टा लगा दिया ऊपर से भी नीचे से भी, इसके बाहर ना प्रॉफिट होगा ना लॉस होगा. So that is a collar. Now there is one more strategy which is called as collar plus. And what is collar plus? It is same as collar, where we have a future long which is hedged with synthetic future. Means we buy a future and we sell call and we buy put. This way with future long we have synthetic future short. That is same as collar. What is additional in collar plus? In collar plus there is additional call shorting. It is shorted as covered call. So collar plus is simply a naked call short with a future long position and synthetic future short position. This way shorted call will give us profit, but if prices increase then that call may show loss. It is as good as a naked call short. Okay, any confusion, any question in this?